morning, everyone. We are excited to present our video presentation on economic aspect of public debt presented by the Group 1. So, by the way, I am Brooklyn R. Undag, the first reporter. So, the contents of our report are: what is the public debt, why the government need to incur public debt, types of public debt, classification of public debt, effects of public debt, redemption of public debt, and public debt management. So, what is the public debt? Public debt sometimes also refers to as government debt, represent the total outstanding debt of the country's government. So, public debt or the government debt, this is the total amount of money a government owns to its lenders. This lender can be individuals, businesses, or even other governments. So, in the simpler terms, public debt is like a country credit card bill. It is a total amount the government has borrowed and has to pay it back with the interest over time. Public debt refer to the amount owned by the different levels of government and used to finance public deficit resulting from higher level of program spending to budgeted income. This debt is used to cover situation where the government spend more than it collects in income, resulting in a public deficit. A country's general government debt to GDP ratio is an indicator of its debt burden, since the GDP measures the value of goods and services produced by the economy during a period, usually a year, as facilitates of comparison across countries of different size. So, higher debt to GDP ratio indicates a higher debt burden for the country. It means that the government owns a larger amount of money relative to the total economic output. So the lower debt to GDP ratio indicates a lighter debt burden. The government owns a smaller amount of money relative to the total economic output. So why is this ratio important? So it helps assess a country ability to repair its debt. A country with a higher debt to GDP ratio might have more difficulty meeting in financial obligation in the future.
Good morning, everyone. I am the next reporter, Leonard Berha, and I'm going to discuss why do governments needs to incur public debt. So there are 7 causes of the increase in public debt. First, developmental planning. Second, unpopularity of taxation. Third, natural calamities. Fourth, waging wars. Fifth, covering the temporary deficit in the budget. Sixth, dealing with depression. And last, controlling inflation. First, I'm going to discuss developmental planning. So, developmental planning is a process in which various strategies, programs, and policies are performed for the development of the citizens and country to improve the economic conditions. Developmental planning consists of building infrastructure, creating employment opportunities, healthcare facilities, and educational institutions. For the development of such facilities, the required initial investment as well as the overall cost is high. Due to their low taxable capacity, developing countries use internal and external borrowings for the financial development of the economy. Besides, the developed countries are use borrowing to finance the construction work of buildings, houses, irrigation, and etc. The second one is unpopularity of taxation. Paying taxes plays a very important role in various public services and government-related operations. These taxes are paid by every individual from their income. Therefore, many people with less income do not consider it as their responsibility. Even the complex structure of government does not help to identify how and for what purposes the taxes are being used by the government. Even the government may provide uneven charges for every individual. Therefore, due to such unpopularity of taxation in public, many times government needs to borrow public debt. The third one is natural calamities. Natural calamities such as floods, earthquakes, and volcanic eruptions occur and create a lot of damage. This leads to unstable environmental as well as economic balance. Many people lost their jobs, homes, and lands. Recovering such as disaster requires more money and time. The government needs to provide such victims with housing, food, safety, and employment facilities. Therefore, the government takes public debt from the people, which will help to manage the loss and improve the economy of the country. Fourth, waging wars. The rise of new wars is also one of the major causes of increasing public debt by the government. In war, finance and major investment are required for weapons, including nuclear weapons. For the security of the soldiers, weapons, safety gadgets, and food, a heavy budget is required. Besides, after their retirement or death, the families are provided with government pensions. Most of the revenue of government is required in war, which reduces their economic balance and thus rises a need to take public debt. Thus, the public debt fills up the gap between the revenue generated and the investment done of war. Fifth, covering the temporary deficit in the budget. Many times, government face the problem of temporary deficit in their budgets. Therefore, the government needs to find shortcomings between its revenues and expenditures. If the government does not make appropriate plans and action on them, many a time they face various issues and have to borrow money from the public. Increasing public debt. Borrowing public debt can provide relief for a small amount of time, but the interest they need to pay goes in increasing. 6. Dealing with depressions. The causes of depressions for the government include economic, financial, and environmental factors. Such depressions can affect the expenditures and savings of the government and increase the rate of public debt. Due to natural calamities, the government needs to expenditures the victims as well as for environment losses. The next factor that occurs in less tax revenue from the citizens. If citizens are also facing financial and economic issues, they are not ready to pay specified tax amount. An increase in government expenses such as employment facilities and government project leads to more expenditures and result in public debts. The last one is controlling inflation. So for the controlling inflation, the need for the public debt arises. During the time of inflation, the value of money decreases. Therefore, to complete the expenses, government has to borrow a large amount of money from the various sources. During inflation, even the value of interest rate increases, due to which even borrowing the public debt becomes more expensive for the government. During inflation, even the economic condition of the country and the value of currency are also affected very badly. Therefore, to cover all the issues and maintain the economy, the government takes public debts from the various sources. Those are the 7 causes of the increase in public debt.
Good morning everyone, I'm Jennifer C. Capoy and my topic is all about the types of public debts. So first we have a short-term, medium-term, and long-term debts. So treasury bills are short-term debts, instruments that mature in less than a year. So typically ranging from a few days to a year. So unlike bonds, treasury bills do not provide regular interest payments. So instead, they are sold at a discount to their face value. So treasury notes are intermediate instruments, so falling between bonds and T-bills in terms of maturity. So they have a fixed interest payments and maturity that typically range from 2 to 10 years. And last, we have also the bonds are long-term debt securities with fixed interest rate and maturity periods. So the investors who purchase government bonds are essentially lending money to the government and receiving periodic interest payments until the bond's maturity, so at which they receive the principal amount. So second, we have a funded debts and unfunded debts. So funded debts are the debts for the repayment of which government forms a separate fund. So each year, the government adds some amount into that fund, so which is used to repay the principal amount of debts. So funded debts are generally for some productive purpose and are long-term debts. So and the unfunded debts are the debts taken by the government to cope with short-term financial needs. So there is no fund maintained by the government to repay such debts amounts. So the government repay these debts out of their regular. And next we have voluntary debts and forced debts. So voluntary debts are taken by the government from the public as per their wish only. So when the public is fully ready to lend loans to the government, so the loan will be known as voluntary debt. And also where areas a loan taken against the will of the public is known as forced debt. For instance, the government of India in 1964 decided to take a forced loan from the public under the compulsory deposit scheme. So the rate of interest on forced debts is generally lower than the rate of interest on voluntary debt. And next we have redeemable debts and the non-redeemable debts. So redeemable debts are the debts taken by the government that it intends to pay back on the maturity period. So the government pays interest on their debts till the maturity period and after the maturity period, so the principal amounts gets repaid. However, the non-redeemable debts are the opposite of redeemable debts. So the non-redeemable debts are never paid by the government. So that the government just keeps paying interest on these debts for an indefinite period. So next we have the internal debts and external debts. So internal debt can be defined as money borrowed by the government from inside the country, and the sources of for internal debts can include citizens, the country banks, the country financial institution, business houses, and etc. So the internal debts are voluntary and or compulsory in nature, and internal debts are mostly used by the government for the betterment of education and health within the country. And work areas, external debts can be defined as the debt borrowed by the government from the outside the country. Sources for external debts can include foreign governments or international monetary funds, which is IMF, World Bank, foreign direct investment or FDI, foreign portfolio investments or FPI, etc. So the government is forced to borrow funds from external sources when the internal sources do not have adequate funds to support the operations of the government. And then last, which is the productive debts and unproductive debts. So productive debts are the debts the government seeks to spend on productive purposes like irrigation system, education, health, and etc. So these productive activities in turn can increase government revenue, which can help in the repayment of interest and repayment of debts. Productive deals help in the increasing production capacity of the country, making it easy for the government to repay the debts. And unproductive debts are the debts taken by the government to spend on non-productive activities like prosecuting the war or facing any natural calamities like floods, epidemics, or pandemics, etc. So these expenses do not contribute to the production capacity of the country. So repayment of unproductive debts is thus for the government. So unproductive debts are also known as the debt with debt.
Good morning, everyone. Classification of public debt. Public debt is classified based on various parameters such as duration, type of payments, promises, funds, and etc. Below is the detailed classification of public debt. First is according to the purpose of the loan. Productive debt is a money you borrow to invest in yourself or your asset with the expectation that it will increase your earning potential or net worth in the long run. Example is mortgage, student loans, and business loans. Unproductive debt is a money you borrow to finance currently living expenses or depreciating asset. This type of debt can weigh you down financially and make it difficult to save your future goal. Example is credit card and car loans. The second one is according to the willfulness of the borrower. Voluntary debt is a debt that you choose to take on, such as mortgage, student loan, or car loan. And the fourth debt is the debt that you can force to take on, such as medical bills or unpaid tax. Third one, according to the source of debt. Internal debt refers to the money government borrows from lender within its own borders. These lenders can be individuals, businesses, banks, pension funds, and government entities. Internal debt is the money of government borrows from lenders outside the borders. This lender can include foreign governments, international organizations, live to the World Bank, or private foreign investors. Fourth one is according to the funds of payment. Funded debt and unfunded debt are two ways to categorize liabilities based on their replacement of payment. They are commonly used in the corporate finance, but in concept can also apply to government finance. 1. According to the feature of maturity, redeemable and non-redeemable debt are two classifications that focus on when the borrower pays back the principal amount of the loan. They are most commonly used for bonds, but the concept can apply other debt instruments as well. Example, mass of bonds sold by corporation and government are redeemable. And non-redeemable, the company may choose to redeem the stock at some point, but there is no guarantee. 6 is according to the duration of debt. Short-term debt and medium-term debt and long-term debt all refers to classification of liabilities or money owned based on how soon they need to be repaid. They are important factors in financial planning for both individuals and businesses.
Good morning, everyone. My name is Floribel Baclayon, and my topic is all about the effects of public debt. There are 7 effects on public debt. First is effect on consumption. Public debt has a contractionary effect on the economy through reduced consumption expenditure. The purchasing power of the customers is reduced due to their contribution towards public debt, making them unable to buy goods and services in the same quantity in which they used to purchase them earlier. It is on account of this that governments all over the world resort to large-scale public borrowings to reduce the impact of inflation. Foreign loans can have a positive impact on domestic consumption. If foreign loans are used for importing those goods and services that are needed by domestic consumers, the result will be increased consumption expenditure and reduced inflationary pressure in the economy. Second, effect on private investment. Public debt leads to less availability of funds for private investors for investment opportunities. Investable funds are limited in the market. If the funds get blocked in the public debt, fewer funds will be available on the private sector. Private debt therefore impedes directly on the availability of funds to the private sector. Third is effect on distribution. Public debt also affect distribution. If the public loans are subscribed by rich people only, and the amounts realized is spent by the government to the economic welfare of poor people or low-income groups, the benefit will be narrowing down of the inequalities and more equal distribution of income between people. However, if the poorer classes have to bear the burden of public debt along with interest payments, the tendency of public debt would increase the inequalities of incomes. The fourth is effect on production. If the people buy government bonds, securities by withdrawing money from their industrial concerns, or by selling debentures and shares of industrial concerns or financial institutions, and even commercial banks subscribe to government loans out of funds meant for investment, then the investment is adversely affected, leading to adverse effects on production. However, if the government utilizes this money in commercial public enterprises, the total investment available for production may not be adversely affected. The fifth one is public debts and credit control. Public debt also produces some impact on the effectiveness of credit control measures by the central bank. It is well known that main contributors to public loans are the commercial banks, which are required to invest a predetermined percentage of their investable funds in government loans in exchange for bonds. These government bonds are highly liquid assets that are converted into cash in no time. 6 is effect on cost of production. The cost of production of a product depends upon the prices of raw materials and other factors used in production. The state utilizes the borrowed money in providing raw materials to the producers at reasonable or concessional rates. The state may also utilize borrowed money in promoting industrial research as well as in providing subsidies to private enterprises. The last one is effect of foreign loans on economy. External borrowing in the economic development of underdeveloped and developing countries has made possible the import of high priority goods or capital goods or goods to be used to create, build, and develop capacity for accelerating the rate of growth of the economy. However, empirical evidence shows that increasing public debt can negatively affect a country's economic growth, with numerous studies identifying a 60 to 90% debt to GDP ratio threshold for positive relationship between public debt and economic growth to be established. Countries with debt to GDP ratio lower than the threshold will observe to have positive growth.
Good day everyone, I am Micah Jessica B. Medina and I am the next reporter. Redemption of public debt. Redemption of public debt is defined as a process of repayment of public debt. The government needs to redeem its debt regularly to increase the confidence of leaders and save the government from bankruptcy. Many times, government needs to take extreme steps that can violate the contract, such as repudiation of debt. Methods of redemptions of public debt. The first method is conversion of public debt. Is defined as the process of converting existing debt into a new debt. So this method reduces the interest burden by converting old loans that bear high interest into new loans that bear low interest. The method of conversion is implemented generally when the rate of interest in the market goes down. The lenders of money are given the instructions to take back their money in the form of cash or the form of new bonds. These methods help taxpayers by reducing their burden of interest. The conversion results in less unequal distribution of income because of the assumption that the taxpayers are mostly poor people whereas the lenders are the rich people. One of example of the converting public debt is through the issuance of government bonds. When a government issues bonds, it essentially borrows money from investors, promising to repay the principal amount along with the periodic interest payments. This helps the government manage its debt by spreading out payments over time. Additionally, governments may also engage in debt restructuring or refinancing to convert existing debt into new obligations with different terms such as longer maturities or lower interest rates. The second method is refunding. Refunding of debt is defined as a process whereas governments issues new securities and bonds for repayment of an old loans or matured loans. In the process of refunding, the short-term securities are replaced by long-term securities. When the refunding method is adopted by the government, there is no burden of public debts. For example, let's say a government has issued bonds at a higher interest rate but over time, market conditions have changed and interest rates have decreased. So the government may decide to refund or refinance its existing debt by issuing new bonds at the current lower interest rates to pay off the older higher interest rates bonds. This allows the government to reduce its interest payments and save money over the life of bonds, similar to refinancing a mortgage to take advantage of lower interest rates. The third method is creation of sinking fund. Creation of sinking fund is defined as a process where the funds are created by the governments and are accumulated each year by keeping them separately so that they are sufficient for paying off debts during the maturity period. Every year, a specific amount of money is transferred to this fund so that it will be enough to redeem public debt. The creation of sinking fund is considered the best and most systematic method of redemption of public debt. While using this method, the overall burden of repaying the debt is felt less as it is evenly distributed throughout the years. So, for example, let's say a government established a sinking fund for its outstanding bonds. It sets aside a portion of its annual budget or revenue specifically designated for repaying its debt. This fund accumulates over time, and when the bonds mature, the government uses the money in the sinking fund to redeem or buy back the bonds. By creating a sinking fund, so the government ensures it has the necessary funds available to meet its debt obligations when they come due, reducing the risk of default and potentially lowering borrowing costs. The fourth method is capital levy. Capital levy is considered the most controversial method as a method where government impose a levy on the assets of rich people or sections of the society. During war of emergencies, governments usually raise the money by imposing a special tax on a capital to redeem public debt. Quick repayment of loans is possible with capital levy. However, using this method has various disadvantages such as it hampers capital formation, employment, and production are also adversely affected. This method is mostly not adopted by the government. An example of capital levy is one of the tax on wealth or assets typically imposed during times of economic crisis or war to raise revenue. So, one of historical example is a capital levy occurred in Germany after World War II in 1923. The German government introduced a capital levy as part of its effort to address the economic turmoil resulting from the war and hyperinflation. The levy was applied to personal wealth and assets, including property, securities, and cash holdings. While controversial, the capital levy was intended to redistribute wealth and establish the economy by reducing the country's debt burden and financing reconstruction efforts. The fifth method is terminal annuity. Terminal annuity is defined as a method where the government pays off its public debt through equal annual installment that consists of principal and interest. The terminal annuity method is similar to the method of sinking funds. Therefore, many times governments decide to end or terminate the public debt using the terminal annuity method. The amount of the terminal annuity is decided based on the annuity table. Through this method, the burden of public debt is reduced every year and paid fully until the maturity period. An example of terminal annuity could be a retirement pension plan where the retiree receives monthly payments for the duration of their life, but upon their death, the payment case entirely regardless of whether any funds remain in the account. So, this type of annuity provides a guaranteed income stream for the annuitant during their lifetime but does not provide any residual benefits to heirs or beneficiaries after death. The sixth method is additional taxation. Additional taxation is defined as a type of method where the government imposes new taxes on people to get the required revenue for repayment of the public debt. This revenue is used to repay the principal amount as well as the interest amount. To pay the old debt, the government levies both taxes such as direct and indirect. This method of additional taxation causes income redistribution as the resources are transferred from taxpayers to the bondholders. Using this method of additional taxation has a discharge effect of the taxes. For example, an additional taxation could be the implementation of a new tax on specific goods or services. For instance, a government may introduce an additional taxation or sugary drinks to discourage their consumption and address public health concerns related to obesity and diabetes. This tax would increase the price of sugar drinks, making them less affordable and potentially reducing their consumptions. These additional revenues generated from the tax could be used to fund healthcare programs or promote healthier lifestyle initiatives.
Budget surplus. Budget surplus is a condition where government incomes are more than government expenses. In case of a budget surplus, the excess earnings can be utilized by the government to paycheck the principal amount borrowed under public debt. The government generally uses the budget surplus to buy its bond and securities from the market. Balance of payments surplus. Public debts can be redeemed using the surplus balance of payments. For this, the country must increase its export and or decrease its imports. This will lead to the accumulation of foreign reserves within the country, which the respective country can use to pay off its public debts. Compulsory reduction in the rate of interest. The government may pass the notice to decrease the interest rates payable on public debts. This generally happens in case of a government budget deficit or any other financial difficulties. In such a situation, the creditors have no other options except to reduce the interest rates. Repudiation. It is a term used when the government refuses to pay back of its public debts. A government can repudiate its international loans. However, the repudiation done by the governments affect their credit score in the money market and makes it difficult to access loans in the future. Public debt management. Sovereign debt management is the process of establishing and executing a strategy for managing the government's debt in order to raise the required amount of funding, achieve its risk and cost objectives, and to meet any other sovereign debt management goals the government may have set, such as developing and maintaining an efficient market for government securities.
Good day everyone, I am Gerandi Macas and I'm going to discuss to you the guidelines for public debt management. So the International Monetary Fund or IMF and World Bank designed a set of guidelines in order to assist policymakers in considering reforms to strengthen the quality of their public debt management and reduce their country's vulnerability to international financial shocks. Vulnerability is often greater for smaller and emerging market countries because their economies may be less diversified, have a smaller base of domestic financial savings, and less developed financial systems, and be more susceptible to financial contagion through the relative magnitudes of capital flows. As a result, the guidelines should be considered within a broader context of the factors and forces affecting the government's liquidity more generally, and the management of its balance sheet. The guidelines cover both domestic and external public debt and encompass a broad range of financial claims on the government. They seek to identify areas in which there is broad agreement on what generally constitutes sound practices in public debt management. The guidelines endeavor to focus on principles applicable to a broad range of countries at different stages of development and with various institutional structures of national debt management. They should not be viewed as a set of binding practices or mandatory standards or codes, nor should they suggest that a unique set of sound practices or prescriptions exist, which would apply to all countries in all situations. The guidelines cover 6 areas of concern, which are debt management objectives and coordination, transparency and accountability, institutional framework, debt management strategy, risk management framework, and development and maintenance of an efficient market for government securities. Let us now proceed to the overview of the guidelines for public debt management. Number 1. Debt management objectives and coordination. The main objective of public debt management is to ensure that the government's financing needs and its payment obligations are met at the lowest possible cost over the medium to long run, consistent with a prudent degree of risk. Prudent risk management to avoid dangerous debt structures and strategies, which includes monetary financing of the government's debt, is crucial, given the severe macroeconomic consequences of sovereign debt default and the magnitude of the ensuing output losses. These costs includes business and banking insolvencies, as well as the diminished long-term credibility and capability of the government to mobilize domestic and foreign savings. Scope. Debt management should encompass the main financial obligations over which the central government exercises control. These obligations typically include both marketable debt and non-market debt, such as concessional financing obtained from bilateral and multilateral official sources. In a number of countries, the scope of debt management operations has broadened in recent years. Nevertheless, the public sector debt, which is included or excluded from the central government's mandate over debt management, will vary from country to country, depending on the nature of the political and institutional frameworks. Coordination with monetary and fiscal policies. Debt managers, fiscal policy advisors, and central bankers should share an understanding of the objectives of debt management, fiscal and monetary policies given the interdependencies between their different policy instruments. Debt managers should convey to fiscal authorities their views on the costs and risks associated with government financing requirements and debt levels. Policymakers should understand the ways in which the different policy instruments operate, their potential to reinforce one another, and how policy tensions can arise. Prudent debt management, fiscal and monetary policies can reinforce one another in helping to lower the risk premium in the structure of long interest rates. Monetary authorities should inform the fiscal authorities of the effects of government debt levels on the achievement of their monetary objectives. Borrowing limits and sound risk management practices can help to protect the government's balance sheet from debt servicing shocks. In some cases, conflicts between debt management and monetary policies can arise owing to the different purposes. Debt management focuses on the cost-risk trade-off, while the monetary policy is normally directed toward achieving price stability. Where the level of financial development allows, there should be a separation of debt management and monetary policies, objectives, and accountabilities. Clarity in the role of and objectives for debt management and monetary policy minimizes potential conflicts. In countries with well-developed financial markets, borrowing programs are based on the economic and fiscal projections contained in the government budget, and monetary policy is carried out independently from debt management. This helps ensure that debt management decisions are not perceived to be influenced by inside information on interest rate decisions, and avoid perceptions of conflicts of interest in market operations. Debt management, fiscal and monetary authorities should share information on the government's current and future liquidity needs. Since monetary operations are often conducted using government debt instruments and markets, the choice of monetary instruments and operating procedures can have an impact on the functioning of government debt markets, and potentially on the financial condition of dealers in these markets. By the same token, the efficient conduct of monetary policy requires a solid understanding of the government's short and long-term financial flows. As a result, debt management and fiscal and monetary officials often meet to discuss a wide range of policy issues. The next section of the guidelines discusses the second area of concern regarding public debt management, which is transparency and accountability. Clarity of roles, responsibilities, and objectives of financial agencies responsible for debt management. The allocation of responsibilities among the Ministry of Finance, the Central Bank, or separate debt management agency for debt management policy advice and for undertaking primary debt issues, secondary market arrangements, depository facilities, and clearing and settlement arrangements for trade in government securities should be publicly disclosed. Transparency in the mandates and clear rules and procedures in the operations of the Central Bank and Ministry of Finance can help in resolve conflicts between monetary and debt management policies and operations. Transparency and simplicity in debt management operations and in the design of debt instruments can also help issuers reduce transaction costs and meet their portfolio objectives. They may also reduce uncertainty among investors, lower their transaction costs, encourage greater investor participation, and over time help governments lower their debt servicing costs. The objectives for debt management should be clearly defined and publicly disclosed, and the measures of cost and risk that are adopted should be explained. Some sovereign debt managers also publicly disclose their portfolio benchmarks for cost and risk, although this practice is not universal. Experience suggests that such disclosure enhances the credibility of the debt management program and help achieve debt management goals. Complementary objectives, such as domestic financial market development, should also be publicly disclosed. Their relationship with the primary objective should be clearly explained. Next, open process for formulating and reporting of debt management policies. Materially important aspects of debt management operations should be publicly disclosed. The Code of Good Practices on Fiscal Transparency, Declaration on Principles, highlights the importance and need for a clear legal and administrative framework for debt management, including mechanisms for the coordination and management of budgetary and extra-budgetary activities. Public availability of information on debt management policies. The public should be provided with information on the past, current, and projected budgetary activities, including its financing and the consolidated financial position of the government. Disclosure of information on the flow and stock of government debt is important. Liberalized capital markets react swiftly to new information and developments, and in the most efficient of these markets, participants react to information whether published or not. Market participants will attempt to infer information that is not disclosed, and there is probably no long-term advantage to the issuer from withholding materially important information on, for example, the estimated size and timing of new debt issuance. The government should regularly publish information on the stock and composition of its debt and financial assets, including their currency, maturity, and interest rate structure. The financial position of the public sector should be regularly disclosed, where contingent liabilities exist. For example, though explicit deposit insurance schemes sponsored by the government. Information on their cost and risk aspects should be disclosed whenever possible in the public accounts. It is also important that the tax treatment of public securities be clearly disclosed when they are first issued. The objectives and fiscal costs of tax preferences, if any, for government securities should also be disclosed. Accountability and assurances of integrity by agencies responsible for debt management. Debt management activities should be audited manually by external auditors. The accountability framework for debt management can be strengthened by public disclosure of audit reviews for debt management operations. Audits of government financial statements should be conducted regularly and publicly disclosed on a pre-announced schedule, including information on the operating expenses and revenues. A national audit body, like the agency responsible for auditing government operations, should provide timely reports on the financial integrity of the central government accounts. In addition, there should be regular audits of debt management's performance and of systems and control procedures. The next section discusses the third area of concern in public debt management, which is the institutional framework. So, governance. The legal framework should clarify the authority to borrow and to issue new debt, invest, and undertake transactions on the government's behalf. The authority to borrow should be clearly defined in legislation. Sound governance practices are an important component of sovereign debt management. Given the size of government debt portfolios, the soundness and credibility of the financial system can be supported by assurances that the government debt portfolio is being managed prudently and efficiently. Moreover, counterparties need assurances that the sovereign debt managers have the legal authority to represent the government, and that the government stands behind any transaction its sovereign debt managers enter into. The organizational framework for debt management should be well specified and ensure that mandates and roles are well articulated. Legal arrangements should be supported by delegation of appropriate authority to debt managers. Experience suggests that there is a range of institutional alternatives for locating the sovereign debt management functions across one or more agencies, including in one or more of the following: the Ministry of Finance, Central Bank, Autonomous Debt Management Agency, and Central Depository. Regardless of which approach is chosen, the key requirement is to ensure that the organizational framework surrounding debt management is clearly specified, there is coordination and sharing of information, and that the mandates of the respective players are clear. Management of internal operations. Risks of government losses from inadequate operational controls should be managed according to sound business practices, including well-articulated responsibilities for staff and clear monitoring and controlling policies and reporting arrangements. Operational risks due to inadequate controls and policy breaches can entail large losses to the government and tarnish the reputation of debt managers. Sound risk monitoring and control practices are essential to reduce operational risk. Operational responsibility for debt management is generally separated into front and back offices, with distinct functions and accountabilities and separate reporting lines. The front office typically is responsible for executing transactions in financial markets, including the management of auctions and other forms of borrowing, and all other funding operations. It is important to ensure that the individual executing a market transaction and the one responsible for entering the transaction into the accounting system are different people. The back office handles the settlement of transactions and the maintenance of the financial records. Debt management activities should be supported by an accurate and comprehensive management information system with proper safeguards. Countries who are beginning the process of building capacity in government debt management need to give a high priority to developing accurate debt recording and reporting systems. This is required not only for producing debt data and ensuring timely payment of debt service, but also for improving the quality of budgetary reporting and the transparency of government financial accounts. The Management Information System should capture all relevant cash flows and should be fully integrated into the government's accounting system. Staff involved in debt management should be subject to a code of conduct and conflict of interest guidelines regarding the management of their personal financial affairs. This will help to allay concerns that staff personal financial interests may undermine sound debt management practices. Sound business recovery procedures should be in place to mitigate the risk that debt management activities might be severely disrupted by natural disasters, social unrest, or acts of terrorism. Given that government debt insurance is increasingly based on efficient and secure electronic book entry systems, comprehensive business recovery procedures, including backup systems and controls, are essential to ensure the continuing operation of the government's debt management, maintain the integrity of the ownership records, and to provide full confidence to debt holders on the safety of their investments. Following the section of institutional framework would be the discussion of debt management strategy in accordance to the given in the guidelines. The risks inherent in the structure of the government's debt should be carefully monitored and evaluated. These risks should be mitigated to the extent feasible by modifying the debt structure, taking into account the cost of doing so. Identifying and managing market risk involves examining the financial characteristics of the revenues and other cash flows available to the government to service its borrowings, and choosing a portfolio of liabilities which matches these characteristics as much as possible. When they are available, hedging instruments can be used to move the cost and risk profile of the debt portfolio closer to the preferred portfolio composition. In order to help guide borrowing decisions and reduce the government's risk, debt managers should consider the financial and other risk characteristics of the government's cash flows. Rather than simply examining the debt structure in isolation, several governments have found it valuable to consider debt management within a broader framework of the government's balance sheet and the nature of its revenues and cash flows. Irrespective of whether governments publish a balance sheet, conceptually all governments has such a balance sheet, and consideration of the financial and other risks of the government's assets can provide the debt manager with the important insights for managing the risks of the government's debt portfolio. Debt managers should carefully assess and manage the risk associated with foreign currency and short-term or floating rate debt. Debt management strategies that include an over-reliance on foreign currency or foreign currency indexed debt and short-term or floating rate debt are very risky. For example, while foreign currency debt may appear ex ante to be less expensive than domestic currency debt of the same maturity, it could prove to be costly in volatile capital markets or if the exchange rate depreciates. Debt managers should also be aware of the fact that the choice of exchange rate regime can affect the links between debt management and monetary policy. There should be cost-effective cash management policies in place to enable the authorities to meet with a high degree of certainty their financial obligations as they fall due. The need for cost-effective cash management recognizes that the window of opportunity to issue new securities does not necessarily match the timing of planned expenditures. In particular, for governments lacking secure access to capital markets, liquid financial assets and contingent credit lines can provide flexibility in debt and cash management operations in the event of temporary financial market disturbances. They enable governments to honor their obligations and provide flexibility to absorb shocks where access to borrowing in capital markets is temporarily curtailed or very costly. However, liquid assets are a more secure source of funds than unconditional contingent credit lines. since financial institutions called upon to provide funds under these lines may attempt to prevent their exposures from expanding by withdrawing other lines from the government. On the other hand, some governments that do have security or secure access to capital markets prefer to minimize their holdings of liquid financial assets and instead rely on short-term borrowings and overdrafts facilities to manage day-to-day fluctuations in their revenues and cash flows. Sound cash management needs to be supported by efficient infrastructure for payments and settlements, which are often based on dematerialized securities in a centralized book entry register. The next section discusses the risk management framework, the fifth area of concern in the guidelines for public debt management. A framework should be developed to enable debt managers to identify and manage the trade-offs between expected cost and risk in the government debt portfolio. The cost of government debt includes two components. 1. The financial cost, which typically is considered to be the cost of servicing the debt over the medium to long run. And 2. The potential cost of real economic losses that may result from a financial crisis if the government has particular strategy for managing the portfolio. Debt servicing costs can be projected forward over the medium to long term, based on assumptions of future interest and exchange rates and future borrowing needs. To minimize bias in choosing among different strategies, some governments use market-neutral assumptions of future interest and exchange rates, which are based on market measures of forward rates or on simple assumptions that rates will remain unchanged and etc. The expected cost can be evaluated both in terms of the project financial impact on the government's budget or other measure of its fiscal position, as well as for possible real cost. If the projected debt service is potentially unsustainable in terms of its impact on future tax rates or government programs, or if there is a potential for default. To assess risk, debt managers should regularly conduct stress tests on the debt portfolio on the basis of the economic and financial shocks to which the government and the country more generally are potentially exposed. This assessment is often conducted using financial models ranging from simple scenario-based models to more complex models involving highly sophisticated statistical and simulation techniques. When constructing such assessments, debt managers need to factor in the risk that the government will not be able to roll over its debt and be forced to default, which has costs that are broader than just to the government's budget. Moreover, debt managers should consider the interactions between the government's financial situation and those of the financial and non-financial sectors in times of stress in order to ensure that the government's debt management activities do not exacerbate risk in the private sector. Scope for active management. Debt managers who seek to manage actively the debt portfolio to profit from expectations of movements in interest rates and exchange rates, which differ from those implicit in current market prices, should be aware of the risk involved and accountable for their actions. These risks include possible financial losses, as well as conflicts of interest and adverse signaling with respect to monetary and fiscal policies. In order to be able to lower borrowing costs without increasing risk by taking market views, debt managers require information or judgment that is superior to that of other market participants. Debt managers may have better information on financial flows in the domestic market and the financial condition of the market participants due to the government's privileged role as a supervisor or regulator of the financial system. However, most governments consider it unwise and unethical to try and capitalize on such inside information, especially in the domestic market. In particular, debt managers and policymakers should not engage in tactical trading on the basis of inside information with respect to future fiscal or monetary policy actions. Next would be the contingent liabilities. Debt managers should consider the impact that contingent liabilities have on the government's financial position, including its overall liquidity when making borrowing decisions. Contingent liabilities represent potential financial claims against the government which have not yet materialized, but which could trigger a firm financial obligation or liability under certain circumstances. They may be explicit or implicit, whether the government does not have a contractual obligation to provide assistance but decides to do so because it believes the cost of not intervening is unacceptable. Unlike most government financial obligations, however, contingent liabilities have a degree of uncertainty. They may be exercised only if certain events occur, and the size of the fiscal payout depends on the structure of the undertaking. The last section of the guidelines discusses the development and maintenance of an efficient market for government securities. In order to minimize cost and risk over the medium to long run, debt managers should ensure that their policies and operations are consistent with the development of an efficient government securities market. An efficient market for securities provides the government with a mechanism to finance its expenditures in a way that alleviates the need to rely on the central bank to finance budget deficits. Moreover, by promoting the development of a deep and liquid market for its securities, debt managers, in tandem with central banks and supervisors and regulators of financial institutions and market participants, can achieve lower debt service costs over the medium to long term as liquidity premium embedded in the yields on government debt wane. In addition, when they have lower credit risks, the yields on government securities serve as a benchmark in pricing other financial assets, thereby serving as a catalyst for the development of deep and liquid money and bond markets generally. This helps to buffer the effects of domestic and international shocks on the economy by providing borrowers with readily accessible domestic financing, and it is especially valuable in times of global financial instability, when lower quality credits may find it particularly difficult to obtain foreign funding. Portfolio diversification and instruments. The government should strive to achieve a broad investor base for its domestic and foreign obligations, with due regard to cost and risk, and should treat investors equitably. Debt issuers can support this objective by diversifying the stock of debt across the yield curve or through a range of market instruments. Such actions could be particularly beneficial to emerging market countries seeking to minimize rollover risk. At the same time, issuers need to be mindful of the cost of doing this and the market distortions that might arise, since investors may favor particular segments of the yield curve or specific types of instruments, and in less developed markets, the nominal yield curve may extend only to relatively short-term securities. Attempting to extend the yield curve quickly beyond that point may be impractical or infeasible. Next would be the primary market. Debt management operations in the primary market should be transparent and predictable. Regardless of the mechanism used to raise funds, experience suggests that borrowing costs are typically minimized and the market functions most efficiently when government operations are transparent. For example, by publishing borrowing plans well in advance and acting consistently when issuing new securities, and when the issuer creates a level playing field for investors. The terms and conditions of new issues should be publicly disclosed and clearly understood by investors. The rules governing new issues should treat investors equitably, and debt managers should maintain an ongoing dialogue with market participants and monitor market developments so they are in a position to react quickly when circumstances require. To the extent possible, debt issuers should use market-based mechanisms, including competitive auctions and syndications. In the primary market for government securities, best practice suggests that governments typically strive, where feasible, to use market-based mechanisms to raise funds. For domestic currency borrowings, this typically involves auctions of government securities, although syndications have been successfully used by borrowers that do not have a need to raise funds on a regular basis, or are introducing a new instrument to the market. Next would be the secondary market. Governments and central banks should promote the development of resilient secondary markets that can function effectively under a wide range of market conditions. In many countries, Debt managers and central banks work closely with financial sector regulators and market participants in this regard. This includes supporting market participants in their effort to develop codes of conduct for trading participants, and working with them to ensure that trading practices and systems continually evolve and reflect best practices. It can also include promoting the development of an active repo market in order to enhance liquidity in the underlying securities and minimize credit risk through collateralization. The systems used to settle and clear financial market transactions involving government securities should reflect sound practices. Sound and efficient payments, settlements, and clearing systems help to minimize transaction costs in government securities market and contain system risk in the financial system, thereby contributing to lower financing costs for the government. Agencies responsible for the payments, settlement, and clearing systems for financial transactions normally work closely with the market participants to ensure that these systems are able to function well under a wide range of trading conditions. To summarize it all, public debt refers to the total outstanding debt a government owes due to the borrowings made to finance budget deficits. Its effect can be beneficial if it helps in the implementation of government projects and initiatives, or harmful if the citizens are burdened in paying unnecessary debts through higher taxes. Therefore, different international bodies provide guidelines to guide countries in doing the widely accepted best practices in relation to public debt. And that would be all for our report. Thank you for listening.